Vernova just reported the largest order quarter in its history, $18.3 billion, 71% organic growth, a backlog of $163 billion. The stock gapped up 14% on the print. The market told a story about artificial intelligence, a picks and shovels play, infrastructure riding the data center wave. The real story is about physics and about what happens when two of the most powerful forces in the modern world land simultaneously on a supply chain that cannot respond fast enough. I'm JL Maurer, and this is Conviction Bet. We believe the stories that move your portfolio are usually quieter than the ones that move the tape. Here's where we're going. We're going to start with the earnings, not as a stock tip, but as a lens into something much larger. Then we're going to build the case for why the world is structurally short on reliable electricity right now and why that shortage is permanent, not temporary. We'll get into what's racing to fill the gap, what the real bottleneck is, and by the end, I want you to understand why the humble turbine blade has become the most important industrial object in the AI era. And then we'll talk about the investment framework, what to accumulate quietly, and whether any part of this has crossed the line into conviction bet territory. Let's start with the quarter. When you read an earnings release, the first thing a serious analyst does is strip out the noise. Because headlines are for headlines. The operating reality is always underneath. This particular earnings release had over $4.3 billion of non-recurring M&A gains sitting inside the headline net income figure. A remeasurement gain from acquiring full ownership of a transformer joint venture. A software business sale on top of that. Neither of those has anything to do with whether the core business is accelerating. Strip them out. You get adjusted EBITDA of $896 million for the quarter. Up 96% year on year. That is the real number. And it is genuinely remarkable. It just isn't the number the headline was selling. Free cash flow came in at $4.8 billion for the quarter. Not just from operations, a large portion of that came from the billions in upfront cash deposits that customers pay just to reserve a slot in the delivery queue. Those deposits hit the cash flow statement the moment they are received, years before any revenue is recognized. The cash balance is now north of $10 billion, and the business has the sheet to deploy it. But none of that is the real story either. The real story is in the orders and the backlog. $18.3 billion in new orders in a single quarter, growing 71% organically, meaning not from acquisitions, not from currency, from actual demand. Across every segment, in every geography. And a total backlog of $163 billion. That is roughly 4.5 years of annual revenue already contracted. You don't build a backlog like that in a normal industrial cycle. That kind of backlog tells you something structural is happening. There's a specific metric worth understanding here. Slot reservation agreements. These are binding contracts where a customer pays a substantial deposit years in advance to reserve delivery capacity. Not an expression of interest. Not a letter of intent. A binding commitment with real money attached. Those agreements grew to 56 gigawatts on a standalone basis last quarter, up from 43 gigawatts the quarter before. Combined with the equipment backlog, the total gas turbine pipeline reached 100 gigawatts, with management targeting 110 by year end. Let's earn that phrase, because it either means something specific or it means nothing. To understand why it might mean something specific, you have to understand how the American power system got to where it is today. Because this did not happen overnight, and it was not inevitable. It is the result of decisions made and not made over 30 years. The United States went through a long, high-growth era in electricity demand after World War II. Heavy industrialization, electrification of the home, air conditioning going from luxury to standard. The grid was built to serve that growth, and it served it well. Then, starting in the 90s and accelerating after 2000, demand growth essentially stopped. The financial crisis hit. The economy shifted from heavy manufacturing to services. Efficiency, technology improved. For roughly 15 years, total electricity consumption in the United States barely moved. And here is where the trouble starts. Because when demand is flat, nobody builds. When nobody builds, the infrastructure ages. And when aging infrastructure meets a sudden demand shock, you have a crisis. Today, 70% of the high voltage transmission lines and power transformers in the United States have been in service for over 35 years. About 30% of core grid assets have exceeded their design lifespan entirely. The average American power transformer is older than most of the people working in technology companies that are now trying to plug into it. Grid capital investment only crossed $30 billion annually for the first time in 2024. To put that in perspective, in that same year, the US built 888 miles of high voltage transmission line. Planning estimates suggest we need roughly 5,000 miles per year. We built less than 18% of what's required. And into this aging, underinvested system, two forces are now colliding simultaneously. Force one is artificial intelligence. Global data center electricity consumption was approximately 415 terawatt hours in 2024. By 2030, the International Energy Agency projects it will reach 945 terawatt hours. That is more than double in 6 years. To put it in physical terms, 945 terawatt hours is roughly equivalent to adding Japan's entire annual electricity consumption to the global grid. But inside that headline number, AI-specific infrastructure is growing even faster. AI-optimized servers are expected to grow approximately 4.6 times between now and 2030, from around 93 terawatt hours to 432. That is Gartner's estimate. By the end of this decade, AI servers alone will account for nearly half of all data center power draw. Now, the volume matters. But the character of this demand matters just as much. Traditional data centers have what people in the industry call a tidal effect. They're busy during business hours, quiet at night. Cloud operators have learned to virtualize workloads, share capacity across customers, time shift loads to avoid peak pricing. The grid can plan around that kind of demand. It's predictable. It's elastic. AI training clusters don't work that way. Once a training run begins, the cluster runs at over 90% utilization continuously, for weeks or months at a time. There is no tidal pattern. There is no off-peak. There is only load. And at the microsecond level, it gets more complicated. Because GPU workloads are highly synchronized when thousands of chips shift simultaneously from computation to communication or from idle to full load, the power draw can spike or drop in milliseconds. NERC, the North American Electric Reliability Corporation, has documented a case where a single large data center load dropped from 450 megawatts to 7 megawatts in 36 seconds. 36 seconds. That is not a demand management event. That is a physical shock to a system designed around much slower moving loads. The markets have already priced this anxiety in. The largest regional electricity market in North America runs a capacity auction, a mechanism where buyers and sellers price the right to reliable generation capacity. That auction price went from roughly $29 per megawatt day to nearly $270. That is a 9-fold increase. In a single cycle. Prices don't do that on optimism. They do that when buyers genuinely believe supply may not be there when they need it. Force two is geopolitics. And this one is less talked about in the context of the power trade, but I think it may be the more important force for the long term. When Russia invaded Ukraine, it didn't just start a war. It permanently changed how governments think about energy. The European Union's dependence on Russian natural gas was roughly 45% before the invasion. By 2025, that figure had fallen to approximately 12%. That restructuring happened in under 3 years, under duress, at enormous financial and political cost. The lesson every policymaker took from that experience and will not unlearn is that energy sovereignty cannot be purchased at spot when you need it. It has to be built in advance, quietly, with patience, before the crisis arrives. Then look at what happened in the Red Sea in 2024. Houthi attacks on commercial shipping forced major carriers to reroute around the Cape of Good Hope, adding weeks to transit times for oil and LNG tankers. At its peak, roughly 15% of global trade volume was being rerouted. It was not a full blockade. It was a partial disruption. And it was enough to send insurance premiums for tankers through the roof and concentrate every energy importing government's mind on exactly how fragile their supply chains were. Now imagine the Strait of Hormuz itself, the choke point through which roughly 20% of global oil trade flows. Not a partial disruption, a real closure. That is the tail risk that the energy security community is now actively pricing. The IEA and major central banks have run the scenarios. A full Hormuz closure would remove over 10 million barrels per day from global markets. No strategic reserve release in history has been large enough to fully offset that. The point is not that it will happen. The point is that governments and corporations who used to dismiss that scenario as unthinkable are no longer dismissing it. The lesson from Ukraine, confirmed by the Red Sea, reinforced by every energy security scenario being run in Washington, Brussels, and Tokyo right now, is the same. Energy that is domestically produced, domestically controlled, and physically immune to shipping lane disruption has acquired a strategic premium that has nothing to do with its cost per kilowatt hour. Governments and corporations are now willing to pay for reliability and sovereignty that they previously assumed would always be available when they needed it. That is not a temporary shift in buyer behavior. That is a permanent repricing of what dispatchable domestic power is worth. So you have two forces. AI creating an unprecedented demand signal for firm, always-on power. Geopolitics creating a mandate to build domestically, quickly, at scale, with no dependence on supply chains that can be severed overnight. The question a serious investor has to ask is this a cycle or is it a structural shift? The answer matters because cycles mean revert. Structures persist. And the investment framework is completely different depending on which one you're in. Here is why I think this is structural. Over the last decade, the United States built an enormous amount of new electricity generation capacity. Wind and solar installations grew from under 50 gigawatts to 329 gigawatts between 2011 and 2024. That is a more than five-fold increase. Over the same period, coal generation fell from 318 gigawatts to 174. Reliable baseload capacity, coal, gas, nuclear, hydro declined by a net 77 gigawatts. On paper, the grid looks like it's been upgraded. Hundreds of gigawatts of clean new capacity added. In practice, what happened is something more complicated. Solar and wind are what engineers call non-dispatchable sources. They produce power when conditions allow, when the sun is shining and the wind is blowing. They cannot be turned up on demand. And their contribution to the grid's ability to meet peak demand, what's called effective capacity, is a fraction of their nameplate rating. Solar runs at 10 to 20% of rated capacity in terms of reliable peak contribution. Wind is 30 to 40%. Gas, coal, and nuclear run at 80 to 90%. When you apply those factors to everything the U.S. is building versus everything it's retiring over the next 5 years, the net new reliable capacity the grid actually gains is approximately 28 gigawatts. 28. Against a projected demand increase driven by AI data centers and manufacturing reshoring alone, that could reach 80 to 120 gigawatts or more. The International Energy Agency projects the American grid faces a reliability gap, the difference between what it can reliably deliver at peak demand and what the next decade will require of somewhere between 109 and 195 gigawatts by 2030. That is not a prediction. That is arithmetic. It follows directly from what is being built, what is being retired, and what the physics of each source actually deliver when the grid needs them most. And an AI training cluster does not care about average availability. It cares about what happens at 2 in the morning in January during a cold snap when the solar panels are dark and the wind has gone still. This is the problem. And this is why what happens next matters so much. The technology companies building data centers are not waiting for the grid to solve this for them. They have done the math. A data center can be designed, permitted, and built in 18 to 24 months. The interconnection queue, the waiting list to connect new generation to the grid, runs a median of 5 years nationally. In Northern Virginia, where the densest concentration of U.S. data centers sits, that wait stretches to 7 years. 7 years. Your data center is ready. Your GPUs are depreciating, and you are in a queue that won't clear for 7 years. The economics of that are catastrophic for anyone trying to win the AI race. So the largest technology companies are building around the grid. Elon Musk's xAI has been aggressively sourcing mobile and permanent generation equipment for its Memphis supercomputer facility, pursuing gas turbines and large generator sets, specifically to reduce dependence on the local utility grid and accelerate the timeline to full power. The strategy is clear, even if the exact contract details are not public. Build the power yourself, bypass the queue. Google paid $4.75 billion to acquire Intersect Power, a company whose entire business model is built around bypassing the public grid, developing power generation infrastructure co-located directly alongside data centers, so the electrons never have to touch the interconnection queue at all. $4.75 billion, not for technology, not for talent, for the ability to skip the line. This is the context in which gas turbines have become the most strategically important piece of industrial equipment in the world right now. A combined cycle gas turbine, which captures exhaust heat to run a secondary steam turbine, operates at roughly 60% thermal efficiency. It can maintain availability above 95% regardless of weather or season. It reaches full load in about 30 minutes. Its levelized cost of energy is around $70 per megawatt hour lower than any other firm dispatchable power source currently deployable at scale. On every dimension that matters to a data center operator, reliability, dispatchability, speed, cost, the gas turbine is the right answer. The problem is that there are effectively 3 companies in the world that build large gas turbines at scale: GE Vernova, Siemens Energy, and Mitsubishi Heavy Industries. Those 3 companies collectively control about 85% of global gas turbine orders, with an even higher share in the heavy-duty segment. Their combined order books are already filled through 2028 and into 2029 and 2030. Book-to-bill ratios, the ratio of new orders to deliveries, have reached roughly 2-to-1 at the largest manufacturers. Mitsubishi is running closer to 3-to-1. The orders are arriving faster than the product can be made. And here is where the story gets genuinely interesting, because the bottleneck is not where most people think it is. When executives who have tried to procure turbines for their own facilities have been asked about the supply situation, they have been remarkably candid. The turbines, they say, are not the bottleneck. The blades are. Because casting turbine blades is an extremely specialized and sophisticated process. Let me explain what he meant. A turbine blade operates at temperatures above 1400 degrees Celsius. That is above the melting point of the nickel-based alloys from which the blades are cast. The blade survives because of a combination of single crystal metallurgy, precision-machined internal cooling channels, and thermal barrier coatings developed over decades of aerospace research. While operating at those temperatures, the blade is simultaneously withstanding centrifugal forces tens of thousands of times its own weight for tens of thousands of hours without failure. There are effectively two companies in the world that produce high-end turbine blades at meaningful scale: Precision Castparts and Howmet Aerospace. Together, they control somewhere between 70 and 80% of the global market for the single crystal and directionally solidified blades that GE Vernova, Siemens Energy, and Mitsubishi depend on. And here is why this matters for the supply response timeline. To expand turbine blade production, you need specialized casting equipment, vacuum induction furnaces, primarily from German manufacturers. The lead time for that equipment, from order to delivery, is roughly 18 months. Then installation, calibration, process validation, and certification. The total ramp from committing to expand capacity to producing certified blades at scale takes over 3.5 years. And the blade manufacturers are not rushing to expand. They have been through this cycle before. They watched the gas turbine boom of the early 2000s, driven by the internet infrastructure buildout, and then watched it crash when construction outpaced demand. They are rational actors, and rational actors in capital-intensive industries do not overbuild on the basis of what might be cyclical demand. They also have a more attractive use for their capacity: aerospace engine blades, which carry longer-term contracts, higher batch quantities, and lower scrap rates than power generation blades. So we have a situation where the product that the world urgently needs more of cannot be scaled quickly because the critical component inside it cannot be scaled quickly because the equipment required to scale that component takes years to procure and certify. That is a genuine structural bottleneck. And structural bottlenecks, unlike cyclical ones, do not resolve themselves when capital arrives. Now, the gap between what the heavy gas turbine manufacturers can deliver and what the market needs does not sit empty. It creates a cascade of opportunity for adjacent solutions. And some of those solutions are genuinely interesting. The first tier of alternatives is aeroderivative gas turbines engines derived from aircraft jet engines adapted for power generation. They are smaller than heavy turbines, typically in the 30 to 60 megawatt range. They can be deployed in 12 to 18 months rather than 3 to 5 years. They start up in minutes rather than 30. GE Vernova and Baker Hughes, both with deep aerospace heritage, collectively hold about 63% of this market. The second tier is reciprocating gas engines, large mid-speed engines, essentially scaled-up versions of diesel generators running on natural gas. They are modular. They deploy quickly. Their electrical efficiency, around 48 to 50%, is lower than a combined cycle turbine, but meaningfully higher than a high-speed diesel genset. And critically, they can follow load within minutes, which makes them ideal for smoothing the volatile demand profile of an AI cluster. Caterpillar alone already has over 8 gigawatts of contracted data center orders in this space, with a pipeline well beyond that. Wärtsilä, the Finnish marine and energy engine maker, has carved out a strong position in mid-speed systems and already holds gigawatt-scale data center commitments of its own. The third alternative, and the most counterintuitive, is solid oxide fuel cells. These are electrochemical devices that convert natural gas directly to electricity without combustion. Their electrical efficiency runs between 55 and 65% higher than any combustion technology. They run quietly, with minimal emissions, and can be sited almost anywhere. But their most important feature for the current moment is deployment speed. A 50 megawatt system can be installed and generating power within 90 days. 100 megawatts in 120 days. When the heavy turbine manufacturers are booked into 2030, 90 days is not a minor advantage. It is a completely different value proposition. The global market for these systems is still small, roughly $1 billion in 2024. But Bloom Energy, the dominant player in commercial solid oxide fuel cells, has seen its product order backlog grow by 140% year on year, with total contracted value now approaching $20 billion. That is a company whose role in the energy system is changing faster than most people have recognized. Battery storage sits alongside all of these. Not as a baseload solution, batteries cannot provide the around-the-clock firm power that AI clusters require, but as a critical complement. Batteries smooth the millisecond volatility problem. They reduce peak demand charges. They allow data centers to qualify for grid interconnection in constrained markets by demonstrating they can manage their own load spikes. The global battery energy storage market was roughly $32 billion in 2025 and is projected to reach over $160 billion by the mid-2030s. Data center-specific battery deployment is growing even faster. Some estimates put it compounding at over 80% annually through 2030. And then further out, nuclear. Specifically, small modular reactors, factory-built units below 300 megawatts, designed to be deployed in 3 to 5 years, rather than the 10 to 15 that conventional nuclear requires. Microsoft has signed a 20-year power purchase agreement with Constellation Energy to restart the 3 Mile Island nuclear plant in Pennsylvania, now rebranded as the Crane Clean Energy Center. Amazon has invested in X Energy to develop small modular reactor technology. Google has signed a multi-unit purchase agreement with Kairos Power. These are not moonshots. The first commercial deployments are targeting the early 2030s. And the geopolitical energy anxiety generated by the last few years has done more for the political viability of nuclear power than 20 years of advocacy. One more thing worth understanding the geographic dimension of this problem. Because not every country is in the same position. The United States faces a structural mismatch. The AI buildout is happening in the Northeast and Mid-Atlantic, where the grid is oldest and most congested. The renewable energy is being built in the Midwest and Southwest, where the sun shines and the wind blows. And the transmission infrastructure connecting the two is not being built anywhere near fast enough. China, by contrast, has been deliberately routing its AI infrastructure toward its western provinces, regions rich in hydroelectric and wind power, connected to its eastern population and industrial centers via ultra-high voltage transmission lines that China has spent the last decade building. In 2025, renewable power in China reached roughly 38% of total electricity consumption. Wind and solar combined capacity exceeded coal for the first time in history. That is not an accident. That is 20 years of deliberate infrastructure investment paying off at exactly the moment the world needs it. The contrast matters for understanding where the structural vulnerabilities in AI infrastructure actually sit, and which geographies are better positioned to sustain the build-out over the next decade. So let's bring all of this together into something useful. The investment thesis here operates at 3 levels. And being clear about which level you're at matters, because the time horizon and the risk profile are different at each one. Level 1 is the structural thesis. The world is running a multi-decade underinvestment in firm, reliable power generation at the same moment that demand is accelerating structurally. That gap is not going to be resolved in a quarter or a year. The arithmetic of grid reliability, interconnection timelines, and equipment lead times makes a multi-year demand signal for everything in this ecosystem close to mathematically certain. At this level, the thesis is not really about any specific company. It is about a sector. Level 2 is the equipment trade. Gas turbines, turbine blades, aeroderivative engines, mid-speed reciprocating engines, power transformers, high-voltage switchgear, HVDC transmission equipment, the physical infrastructure that has to be built, replaced, or upgraded. Transformer lead times have stretched from 6 to 9 months to 2 to 3 years. Domestic manufacturers in the United States can meet only about 30% of transformer demand. These are not software margins. But they are real scarcity dynamics, and scarcity has a price. Most of the interesting names here have very long order books, which means revenue visibility that is unusual for industrial companies. Level 3 is the valuation reality check. And this is where I want to be honest, because the quiet velocity framework demands honesty. The gas turbine manufacturer, whose earnings opened this episode, GE Vernova, is now trading at roughly 45 to 50 times 2026 adjusted EBITDA at current post-earnings prices. That multiple is based on the company's own full year guidance, 12 to 14% EBITDA margin on $44 to $45.5 billion of revenue, not on an annualized run rate from a single quarter. The wind segment inside the same business lost $382 million of EBITDA in the first quarter alone, with tariff headwinds adding another $250 to $350 million in expected drag for the full year. The profitable core is carrying real dead weight. This does not invalidate the thesis, but it changes the question. A business whose order book is genuinely structural, whose backlog gives 4.5 years of revenue visibility, whose market position in an oligopolistic industry is unlikely to erode that business, deserves a premium multiple. The question is whether the current premium already prices in the next 3 years of execution. And at this valuation, I think the honest answer is most of it, yes. What that means in practice is this. For the structural thesis, the idea that the world needs more reliable power, that the equipment supply chain is constrained, that this plays out over a decade, there is a strong case for quiet accumulation across the ecosystem. Not concentrated in any single name, spread across the equipment chain. The thesis does not depend on one company winning. It depends on a problem being real. And the problem is real. For the conviction bet, the moment where you concentrate heavily, where you move with full force, I think we are not there yet. Not because the thesis is wrong, but because the best conviction bets are uncomfortable, they are underpriced. They are contested. They do not have $163 billion backlogs and 14% gap up mornings on the back of their earnings. The moment the whole market sees the same story you see, the opportunity has already partially closed. What I am watching for is the place in this ecosystem where the structural reality is clear, but the market pricing hasn't fully caught up. Bloom Energy, whose role is changing faster than its valuation reflects. The grid equipment companies, the transformer and switchgear makers whose backlogs are as structurally supported as the turbine backlogs, but are trading at lower multiples. The nuclear developers, Kairos Power, X Energy, and others whose timelines are real, but whose market pricing still treats them as speculative. Those are the places where preparation and courage can meet productively. The physics of this situation do not negotiate. The AI clusters need power. The grid cannot provide it fast enough. The equipment that can close the gap takes years to build. And every year of delay is a year of GPU depreciation with no return. That is not a story that resolves itself in a quarter. That is a structural condition that persists for years. Accumulate quietly in the parts of the ecosystem that are genuinely underpriced, build the conviction, and stay patient. The bet that changes everything will be more uncomfortable than what the market is currently offering. Anyway, that's this week. If you prefer to read, the show has a Substack called Quiet Velocity. Find it at quietvelocity1.substack.com. That's Quiet Velocity, the number 1.substack.com. And if you're enjoying Conviction Bet, subscribe wherever you get your podcasts, Apple, Spotify, wherever you listen. Leave a review if you have 30 seconds. It genuinely helps new listeners find the show. Until next time, stay patient, stay skeptical, and keep your eye on the quiet stuff. I'm J.L. Maurer. This has been Conviction Bet.